Hello and welcome. You're watching The Investing Edge. I'm Sumaira Abidi. This week, we come to you from the city of joy, Kolkata. With me, I have Mr. Anand Rathi, the chairman of the Anand Rathi Group, and Feroze Azeez, the deputy CEO of Anand Rathi Financial Services. So wealth management as a science has evolved rapidly over the last many years, and it still has a lot more to go in terms of growth. So how do you actually navigate this space? How do you deal with the current environment? Those are some of the questions that we'll be answering today. Okay, so Feroze, in this environment, there are these slowdown worries all around us. Global worries are peaking. How does one make investment in a situation like this? And how do you manage these various risks?
Risk is what sets us apart from each other. Why is anybody different from in an economic status perspective is because he took the right risks at the right time, or he took them, he measured them, he managed them. That's why there is an economic difference. If all of us were not permitted to take risk, then we all over a period of time converge to the same economic status. So risk is a positive word, provided we know how to measure it, we know how to interpret that measurement, and we also know recourse after the measurement. Now, for example, when we're speaking of risk, there are 3-4 risks which each of us should be conscious of and should be clear of. And I think the advisor's key job is to bring clarity in the minds of people so that they can take more prudent decisions. So, point 1 is market risk. Price ka utar chadhav. Price changes are called market risk. Second risk is credit risk. Credit risk मतलब किसी को उधार दो आप, वो लेके भाग जाए या फिर उसको वापस करने की क्षमता ना हो. That's called credit risk. तीसरा, liquidity risk. Fourth, event risk. So, when you have a strategy in place, most of these speed breakers becomes evened out.
Feroze, since we've spoken about risk, credit and liquidity both, regulations have been tightened on, say, liquid funds. The institutional investors in liquid funds now find that they can no longer use it for just the short term that they were using it for. One of the more prominent ways in which mutual funds were investing, or rather lending, was this loan against shares. That has been made more stringent. Are funds like liquid funds, etc., are they going to lose their relevance now for many investors?
I don't think it will lose relevance. I think that might be an aggressive conclusion to derive out of this. But one thing is, mutual funds are going to be a very large portion of one's wealth, and they should be if they are not already. Because they give a very diverse platform of different kinds of asset wrapped under one name. The frequency with which SEBI is bringing regulation on different aspects of mutual fund has gone up substantially, which is a good news from an investor standpoint. Of course, recent times, mutual fund industry lent to good corporates, which were supposedly good corporates. They were AAA rated corporates, but they defaulted. And people should derive right learnings from that episode. Even AAA rated corporates can default. And in fact, they have defaulted several times in the past. So please don't just use rating to measure your credit risk, but this further regulation, I think, was very required.
Given that things are so volatile, what should be the debt strategy now for investors?
So if you want to have a debt strategy and you're serious about it, then if you have any money in a debt mutual fund, you need to know 4 numbers of your portfolio. You should know how many companies have you indirectly lent to. म्यूचुअल फंड खरीदते हैं हम, तो वो और 40 कंपनियों को पैसा देता है. दूसरे फंड खरीदता हूं तो वो और 30 कंपनियों को पैसा देता है. तो एक्चुअली मेरे पैसे कौन सी कंपनियों में गए हैं, उसकी कितनी कंपनियां हैं, उसकी जानकारी फर्स्ट आपके पास होनी चाहिए. जैसे माय पोर्टफोलियो हैज 6 डेट फंड्स. इफ यू आस्क मी हाउ मेनी पीपल हैव यू एक्चुअली लेंड टू, आई विल टेल यू आई हैव लेंड टू 157 पीपल, मतलब इश्यूअर्स और कंपनीज, राइट. सेकंड, और ये देखना है कि इन 157 में से सबसे ज्यादा पैसे कौन सी 10 कंपनियों को गए और क्या वो 10 कंपनियां मजबूत हैं कि नहीं है. तो अब मेरे पोर्टफोलियो में सबसे बड़ी कंपनी है यूपी पावर, 4% लगा हुआ है. अगर मेरी सबसे बड़ी कंपनी भी डूब गई तो मेरा 4% पैसा डूबने वाला है 100 रुपए में से. Then the third number you should know is called modified duration. So duration tells you that जब ब्याज ऊपर जाता है, जब भी ब्याज ऊपर जाएगा तो आपके डेट फंड को नुकसान होता है, जब ब्याज दरें नीचे जाती हैं तो डेट फंड में फायदा होता है. ये जो ड्यूरेशन आपको इस रिस्क की इंतहा बताता है. What is this? How much is this risk? So duration will tell you the extent of risk of interest you are taking. So these are the 3-4 numbers. Your debt strategy should comprise of a limit on all these, and you should measure it as a beginning. If you measured it, then you will be curious, then you will take step 2, step 3 and manage it. That's the debt strategy which I adopt for my money and a few of my clients.
All right, fair enough. Mr. Rathi, I have one question for you regarding this entire situation as it's unfolded in the debt space. Would this qualify as a situation in need of assistance from regulators?
I also believe that this doesn't call for systematic risk, but obviously it calls for better regulations. And I think what SEBI is doing, as Feroze said correctly, I think as the size of these funds is growing, and it's all investors' money, and it's very important to make sure that the confidence of investors in mutual fund keeps on increasing. Because I think in long term, the mutual funds are obviously going to be better managed than people can manage at individual level. So I think the regulations need to be better and better. SEBI is going in the right direction to my mind, but obviously it doesn't have a systematic risk as I think they have been, even without regulations, they have been prudence, not that people have been imprudent. I think the real problem in our country is that the equity base of most of the even larger companies is limited. I think what is needed is that equity base needs to increase, and what SEBI or governments need to do is to encourage, to bring more money into equity, because highly leveraged, companies will always have that risk of, when the bad time comes. And so I think our problem is very high debt equity ratios rather than systematic risk. So I would interpret it that I think someday the message should go very clear that money, in last few years, money has come into equity mutual funds because of the other markets, real estate market going bad, gold not doing well. But real thing is that we need more and more equity if we want to grow. And therefore, I think, some of the steps which I think needs to be considered, like, bringing down distribution commission is not something great, because I think for every product you need distributor commission. You go to any market. If you have to capture a retail market, one of the strategy which companies need to do is to increase their distributors' involvement. You have to make it viable. So anyway, I think this is something which I brought in, which you didn't ask. But to my mind, I think that regulation, the SEBI is moving in the right direction. I think the concentration part needs to be looked at. And I said the JAD score is not being used right now, which needs to be, I think, brought in by all the funds.
Okay, Mr. Rathi also spoke about real estate, as did Feroze earlier. Is that something you advise? Is real estate one of those product categories that you recommend at all?
No, I think Indians have so much real estate that if I recommend real estate, then I think I'm not a good advisor in the first place. You see almost 55 to 60% at least of people's money being in real estate, right? Globally, that allocation is 16 to 17%. It's important to be more pragmatic, not get too emotional with real estate. And I think looking at the data, next 3-4 years, residential metro real estate might not appreciate significantly, or maybe low single digit is the expectation.
Just to add what Feroze said on affordability, I think there has to be, relationship between income levels and property prices. The affordability, if property prices increase faster, which have happened, to 2011-12, the prices have increased, and therefore people thought that property is very profitable. But the incomes have not risen accordingly. So the moment it goes out of gear, obviously affordability and ultimately demand has to come from consumers. investor demand is only intermittent. It's just a bridge, okay? But I think now the investor demand, obviously, last 5 years, no returns. So demand is going down. So, and also the level of, surplus which is available. We also believe that has been our house view, that next 3 to 5 years, we don't see much returns coming into real estate at all. In fact, we are advising for last year's people to exit the real estate and get into other asset classes.
On that note, we'll take a very quick break, but the Investing Edge will be right back. Stay tuned.